Welcome to this explainer. If you're prepping for your real estate exam, you'll already know that financing can feel like this massive, intimidating maze of numbers and acronyms. But honestly, today we're going to cut right through all that noise. We're transforming all that complex real estate jargon into your ultimate exam shortcut toolkit. So grab your notepads, because we're translating these tricky concepts into clear, actionable math hacks that will have you passing with flying colors.
All right, here's our roadmap for today. We'll be covering 6 straightforward concepts: discount points, loan-to-value ratios, mortgage insurance, simple interest, the PIT package, and signing the final paperwork.
Section 1. Discount points made easy, paying up front to save later.
So you've probably heard the term points tossed around, right? But what are they exactly? Well, just think of points as upfront interest payments. It's basically a way for a borrower to buy down their interest rate before the loan even starts. Now, the golden rule here is that 1 point costs exactly 1% of the total loan amount. But, and this is a critical distinction for your exam, paying 1 point does not lower the interest rate by a whole percentage point. Usually it only drops the rate by 1/8 to 1/4%. Okay, before we even look at an example, I've got a crucial secret for your exam. It's like this simple magical translation from English to math. Anytime you see the word of in a word problem, it literally just means to multiply. So if a question asks for 2% of the loan amount, your brain should immediately just picture a multiplication sign. I promise, this tiny math hack is going to save you so much time and second guessing.
Let's actually put this hack to the test with a scenario you might see on test day. Meet our buyer, Jody. Jody just got a home loan for $340,000. She wants to lower her interest rate, so she agrees to pay 2 points at closing. The big question is, how much will Jody actually have to pay in points at the closing table? Let's break it down.
A super easy way to map this out without getting your wires crossed is by using a simple T-chart. We know she's paying 2 points, which, remember, means 2% of the total loan amount. We take our loan amount of $340,000 and pop it right into the total column. Then we take our 2%, but we've got to convert it into a decimal to use it. Just divide 2 by 100, which gives us 0.02, and we place that right in the rate column.
Remembering our handy math hack, we just multiply those two numbers together. 340,000 times 0.02. Do that, and boom, we see Jody pays exactly $6,800 at closing. It really is that simple. Don't let the word points freak you out. It's literally just basic percentage multiplication.
Section 2. Understanding loan to value, or LTV, measuring your borrowing power. When it comes to memorizing formulas for the exam, you're going to love this one because it's an absolute breeze. The best part about LTV is that the formula is literally right there in its name, loan to value. You just take the loan amount and divide it by the market value or sales price of the property. Now your calculator is going to spit out a decimal, so the only trick here is to remember to multiply by 100 or just move the decimal 2 places to the right to turn it into a percentage. Let's picture this visually. Imagine you're buying a house worth $200,000 and you take out a loan for $160,000. Your LTV is $160,000 divided by $200,000, which equals 0.8 or 80%. This perfectly illustrates that you've got an 80% loan slice, which leaves a 20% slice, and that's your down payment. Now, why do lenders care so much about this? Well, a lower LTV means a bigger down payment, which translates to way less risk for the lender.
Section 3. Navigating PMI and MIP, the less than 20% club.
So, what if your down payment doesn't quite hit that magical 20% slice? Well, welcome to the world of mortgage insurance. Essentially, you're hiring a bodyguard for the lender. For conventional loans, this is called private mortgage insurance, or PMI, and it protects the lender if the borrower defaults. But here's the cool part. PMI is temporary. Once your equity hits 20%, you can usually wave goodbye to it. Compare that to FHA loans, which use MIP, or Mortgage Insurance Premium. MIP actually requires an upfront premium right at closing, plus an annual amount that you pay monthly.
Section 4. Calculating simple interest, the cost of borrowing.
Think of interest as the rent you pay to borrow somebody else's money. To calculate it, we use the simple interest formula, which is beautifully straightforward. I equals P times R times T. I is the interest amount. P is the principal, which is just your starting loan balance. R is the interest rate as a percentage. And T stands for time, which is strictly based in years. Let's walk through it. And hey, if math isn't your favorite thing, don't sweat it. This is really just basic multiplication. Say you borrow $100,000. That's your principal. The bank gives you a 5% interest rate.
You've got to convert that 5% into a decimal by dividing by 100, giving you 0.05. Finally, we want to know the interest for just 1 year, so our time is 1. You simply multiply straight across, 100,000 times 0.05 times 1.
Do the math, and you get $5,000. Yep, you're paying $5,000 a year just for the privilege of using the bank's money. Understanding how this rent on money works is absolutely essential when you're guiding clients through their long-term financial planning.
Section 5. The PITI Payment Package, the secret sauce of mortgages. PITI. It's a catchy little acronym, but it really is the secret sauce of a mortgage payment. It's the all-in-one package deal that represents the true total cost of homeownership on a monthly basis. It stands for principal, interest, taxes, and insurance. Knowing this whole picture helps buyers budget for reality, looking way beyond just the loan itself.
All right, let's tackle a beefy multi-step exam question together to see how this actually works. Meet Bob and Susan. They're buying a home for $125,000. They've got an 80% LTV ratio, and they secure a 20-year loan at 7.5%. Using a standard chart, their payment factor is 8.06 per $1,000 borrowed. So, the question asks, what is their exact monthly principal and interest payment?
Take a breath. We're just going to follow the steps. Step 1. Find the actual loan amount. We take the purchase price of $125,000 and multiply it by their 80% LTV, which is 0.8. That gives us a loan amount of $100,000. Now, step 2. This is the trick step where people always stumble on the exam. Because the payment factor is based per $1,000, we must divide our loan amount by 1,000. 100,000 divided by 1,000 gives us 100. Finally, step 3. We just multiply that 100 by the given payment factor of 8.06. And just like that, we find their monthly principal and interest payment is exactly $806. To get their full PITI payment, they would just divide their yearly property taxes and yearly homeowners insurance by 12 and add those monthly numbers right on top of this $806.
Section 6. Signing the final paperwork, the dotted line.
Okay, time to cool down the math. It's incredibly easy to mix these next two documents up on the exam, so let's make it crystal clear. The mortgage is essentially the roadmap. It outlines the terms, the conditions, and the responsibilities of the loan, and legally ties the property to the loan as collateral. On the flip side, the promissory note is the actual signed contract. It's the legal IOU issued by the lender and signed by the borrower. Signing that promissory note is what legally obligates the borrower to actually repay the borrowed amount plus the interest we just learned how to calculate. So, with these formulas and concepts officially in your toolkit, the financing section of your exam really doesn't have to be a stumbling block. You now know that of means multiply, the LTV formula is literally staring at you in its name, and you know the exact step-by-step process to calculate a PITI payment. So the ultimate question is, are you going to let these financial terms intimidate you, or are you going to use this toolkit to absolutely crush your exam and step effortlessly into your new real estate career?